The banks smash the paper price to 61.96. They want you to believe the rally is over. They want you to believe that silver is just a speculative bubble that just popped. They are lying to you. Not just a little lie. This is a lie of omission so massive it borders on criminal negligence. While you were staring at the COMEX ticker yesterday, while the algorithms were dumping paper contracts in New York, something happened in South Korea that makes the price of silver irrelevant. Something happened that changes the fundamental chemistry of the global energy transition. Samsung SDI, one of the largest battery manufacturers on the planet, just quietly confirmed the specifications for their new solid-state production line. The media is calling it a battery breakthrough. They are talking about 900-mile range at 9-minute charging, but they are missing the single most important detail. The detail that Wall Street has not priced in. The detail that the mining companies have not prepared for. The detail that makes 1.1 billion ounces of deficit look like a rounding error. The secret ingredient in Samsung's new battery is not lithium, it is not cobalt, it is not nickel, it is silver, and not just a trace amount. We are talking about a massive structural increase in silver consumption per vehicle. We are talking about a technology that moves silver from being a precious metal to a strategic energy metal. In this deep dive, I am going to expose the silver bomb that Samsung just dropped on the global supply chain. I am going to walk you through the chemistry of the silver carbon anode. I am going to do the math that the IEA refuses to publish. The math that proves there is not enough silver on Earth to electrify the fleet using this technology. And I'm going to show you why the recent price drop to $62 was not a crash. It was the last chance you will ever have to buy silver before the auto industry realizes they have made a fatal calculation. The banks are playing a paper game. Samsung is playing a physics game. Physics always wins. This is the story of the silver carbon revolution. To understand why this news is an extinction-level event for silver supply, you have to understand a little bit of chemistry. Do not worry, I will keep it simple. For 30 years, the world has run on lithium-ion batteries. Your phone, your laptop, the Tesla Model Y in your driveway, they all use liquid electrolyte lithium-ion batteries. They are great, but they have a fatal flaw. It is called the dendrite. When you charge a lithium battery fast or when you charge it too many times, the lithium ions form these little needle-like crystals called dendrites. They grow like jagged roots inside the battery. Eventually, they pierce the separator, the wall between the anode and the cathode. When that happens, boom, short-circuit thermal runaway fire. This is why EVs take 45 minutes to charge. You have to charge them slowly to prevent dendrites. This is why they catch fire. This is why they lose range in the winter. The holy grail has always been the solid-state battery, a battery with no liquid, no fire risk, instant charging, double the range. Samsung just found the silver key to unlock it. Every major automotive company from Toyota to Volkswagen has been promising the solid-state battery for over a decade. They called it the holy grail of transportation. But for 10 years, they all failed. They failed because they could not stop the dendrites from forming on the anode. Graphite anodes did not work. Silicon anodes expanded too much and cracked. Pure lithium metal anodes were too unstable and dangerous. Then the researchers at Samsung SDI found the absolute solution. They discovered that one specific element, when applied as a nano-composite layer, completely solved the problem. It allowed the lithium ions to move freely, but it stopped the dendrites cold. It was stable. It was conductive. It was perfect. That element is silver. Specifically, a silver carbon nano-composite layer. This is not just a theory or a lab experiment anymore. This is published science. Samsung's prototype cells use a thin layer of silver mixed with carbon to regulate the deposition of lithium. The silver acts as a perfect host for the lithium ions. It dissolves them evenly across the surface, preventing the sharp spikes from forming. This allows the battery to be smaller, lighter, faster, and most importantly, safer. But there is a catch. A massive catch that the world is not ready for. To make this battery work, you need silver. And you do not need micrograms of it. You need grams of it. For the first time in history, silver is not just being used for its electrical conductivity in a switch. It is being used as an active material in the electrochemical storage process itself. It is becoming part of the physical DNA of the battery. And the global auto industry is about to scale this technology to millions of cars. Do you see the problem yet? You might be thinking, okay, so they use a little silver, so what? Cars already use silver. Let us put this into context with real numbers. Right now, a standard combustion engine car uses about 15 to 20 grams of silver. It is in the window, switches the seat motors, the defrosters, and the ECU. An electric vehicle uses more, about 30 to 50 grams. It is in the inverters, the battery management system, and the high-voltage cables. This existing EV bump is already draining the market. It is a major reason why we have been seeing a persistent deficit in the silver market for the last 4 years. But the solid-state battery changes the math entirely. We are not talking about small switches anymore. We are talking about coating the anode of every single cell in a 1,000-pound battery pack. Early estimates from the Samsung technical papers suggest the silver loading could be significantly higher than anything we have seen before. Some aggressive estimates suggest it could be as high as 0.5 to 1 kilogram of silver per vehicle for high-performance long-range packs. Let us be conservative. Let us be extremely conservative for a moment. Even if the industry finds a way to use only 100 grams of silver per car, that is still a 500% increase over current electric vehicles. When you multiply that by millions of units, the numbers become terrifying for the supply chain. The dendrite is dead, but the era of cheap silver died with it. To understand the magnitude of what is happening, you have to look at the specific engineering choice Samsung SDI has made. This is the silver code. In the world of battery science, there is a concept called energy density. It is the amount of energy you can cram into a specific amount of space. For years, lithium-ion technology has been hitting a wall. We could not make the batteries more dense because they would become unstable and explode. Samsung solved this by moving to a solid electrolyte and using the silver-carbon layer. This silver-carbon layer is only about 5 micrometers thick, but its impact is monumental. The silver acts as a catalyst. It creates a silver-lithium alloy during the charging process. This alloy is the secret to why the battery does not degrade. In a normal battery, the lithium ions are like unruly crowds trying to push through a single door. They pile up and create those dangerous dendrites we talked about. But in the Samsung silver carbon anode, the silver acts like a perfectly organized docking station. It guides every single lithium ion to its proper place. This is why Samsung can claim a cycle life of over 1,000 charges. That is nearly 500,000 miles of driving over the life of a car. This technological shift changes the nature of silver demand forever. In the past, silver was an industrial spice. You sprinkled a little bit on a circuit board or a solar cell. Because the amount was so small, the price of silver did not really matter to the final product. If silver went from $20 to $100, the cost of an iPhone only went up by a few cents. Apple did not care. But with the silver carbon revolution, silver becomes a structural component. It becomes a major line item in the bill of materials for the most expensive part of the car, which is the battery. If a luxury long-range battery pack requires 500 grams of silver at $60 an ounce, that is over $1,000 worth of silver in every single vehicle. If the price of silver spikes to $200, the cost jumps to over $3,000 per car. This creates a massive headache for auto manufacturers who operate on razor-thin margins. They are now hostage to the periodic table. They cannot easily substitute silver because the entire architecture of the battery is built around its unique electrochemical properties. Samsung has already started building its pilot production line in Suwon, South Korea. They are not just testing this in a vacuum. They are sending samples to major global automakers right now. When these automakers see the performance data, they will have no choice but to follow. The transition from liquid to solid state is no longer a question of if, but when. And every step toward solid state is a step toward a world that consumes more silver than the earth can provide. The banks in New York are looking at charts of paper contracts and interest rate expectations, but the engineers in Suwon are looking at the physical reality of electrons and silver atoms. The silver code has been cracked, and it has turned silver into the most critical energy metal of the 21st century. You are no longer holding a precious metal for jewelry or coins. You are holding the fuel of the next industrial revolution. Now we must do the math that Wall Street refuses to calculate. We must look at the hard numbers and realize why the current silver price is a mathematical impossibility. Let us start with a conservative baseline. Global car production sits at approximately 90 million vehicles every year. Currently, the world is struggling to produce enough silver just to satisfy existing industrial demand for solar panels and basic electronics. We are already in a structural deficit of over 100 million ounces annually. Now let us layer the Samsung silver bomb on top of that deficit. If the auto industry transitions just 10% of its global production to solid-state batteries using the silver carbon anode, we are looking at 9 million cars. If each of these cars uses a conservative estimate of 100 grams of silver, that equals 900 million grams. To put that in perspective, for the silver market, that is approximately 29 million ounces of brand new annual demand. That might sound manageable until you realize that is just for 10% of the market with a very low silver loading estimate. What happens when the technology scales to 50% of global production? What happens when high-performance trucks like the Ford F-150 Lightning or the Tesla Cybertruck require 500 grams of silver to achieve their range targets? If we reach a point where 20 million electric vehicles are produced with an average of 200 grams of silver per car, we are talking about 128 million ounces of new demand every year. That is more than the entire annual silver production of Peru, which is the second largest producer in the world. Where exactly does this silver come from? The world is not discovering new massive silver mines. In fact, silver mine production has been flat or declining for a decade. Most silver is produced as a byproduct of lead, zinc, and copper mining. You cannot simply turn a dial and produce more silver just because the price goes up. You have to build an entire new multi-billion-dollar copper or zinc mine, which takes 10 to 15 years. The International Energy Agency and other global organizations publish glossy reports about the green energy transition. They talk about lithium and nickel and cobalt, but they are silent about the silver. They are silent because the math is impossible. There is not enough silver above ground, and there is not enough silver being pulled out of the ground to electrify the global fleet using the silver carbon anode. When you combine the massive silver requirements of the solar industry, which is already consuming nearly 200 million ounces a year, with the coming silver requirements of the battery industry, you reach a point of total supply exhaustion. This is why the price drop to $62 is a gift to the informed investor. The market is pricing silver as if demand is linear. But the Samsung breakthrough represents a step function change. It is a vertical leap in demand that the supply side cannot possibly meet. The math does not lie. The world is about to run out of silver at these prices. The numbers we just discussed lead us to a terrifying conclusion that I call the extinction equation. This equation is simple but deadly for the status quo. Total global supply is now less than the combined demand from solar electronics and the new solid-state batteries. We are not even counting investment demand in this equation. We are not counting the silver eagles you want to buy or the bars that family offices want to hoard. The industrial demand alone is on a trajectory to consume 100% of annual mine production. When an industrial metal reaches this point, it undergoes a fundamental transformation. Silver will cease to be a monetary metal available to the average person. It will become a critical strategic material reserved exclusively for high-level industry and national security. In the world of finance, they call this a cornered market, but this time it is not being cornered by a wealthy family like the Hunts. It is being cornered by physics and the global mandate for green energy. The most dangerous part of this equation is the inventory buffer. For decades, the world had a massive stockpile of silver held in vaults like the COMEX in New York and the LBMA in London. These stocks acted as a shock absorber. When demand spiked, the vaults would bleed silver to keep the price stable. But those vaults are now reaching critically low levels. We have seen a steady drain of registered silver for over 3 years. The shock absorber is gone. We are now driving a global economy at 100 miles per hour toward a wall of silver shortage with no brakes. What makes the extinction equation so certain is the lack of a plan B. In the world of semiconductors, if one material becomes too expensive, engineers can sometimes swap it for another. But silver has the highest electrical and thermal conductivity of any element on the periodic table. You cannot replace it with copper in a nano-layer anode and expect the same results. If you remove the silver, the dendrites return. If the dendrites return, the car becomes a fire hazard. Samsung knows this. Toyota knows this. They are effectively hostage to the silver atom. This inelastic demand means that price is no longer a factor for the buyer. If Samsung needs 10 tons of silver to keep a billion-dollar battery factory running, they will pay whatever the market demands. They will pay $60. They will pay $600. The cost of stopping the production line is far higher than the cost of the silver. This is the moment when a market breaks, when the buyers stop looking at the price and start looking at the availability. We are entering an era of industrial cannibalization. The battery industry will have to outbid the solar industry. The solar industry will have to outbid the electronics industry. And all of them will have to outbid the retail investor. The silver bomb has created a scenario where there are too many predators and not enough prey. The result is a vertical price spike that will leave the paper traders at the bank staring in disbelief at their screens. The extinction of silver as a cheap industrial metal is not a possibility. It is a mathematical certainty. Whenever I talk about the silver shortage, the skeptics always scream the same thing. They say, "Do not worry, we will just recycle." They believe that as the price of silver rises, a massive wave of recycled metal will flood the market and save the day. This is the recycling myth, and it is one of the most dangerous misconceptions in the financial world because it gives policymakers and investors a false sense of security. To understand why recycling will not save us, You have to compare silver to gold. Gold is recycled at a rate of nearly 90%. Why? Because gold is used in large concentrated amounts. If you have a gold bar or a heavy gold necklace, it is very easy and profitable to melt it down. But silver is different. Silver is the vampire dust of the industrial world. It is sprinkled in microscopic amounts across billions of devices. There is a tiny fraction of a gram in your cell phone. There is a thin film on a solar panel. There is a nano layer in a missile guidance chip. The cost of the energy, the chemicals, and the labor required to extract those tiny flakes of silver is often higher than the value of the silver itself. This is why silver has a recycling rate of less than 20%. Most of the silver we have mined throughout human history is not sitting in a vault, it is sitting in a landfill. It is dispersed in such small quantities that it is geologically lost to us. We are literally burying billions of ounces of silver back into the earth, but in a form that is impossible to recover. Now consider the new Samsung solid-state battery. Yes, these batteries use much more silver than a cell phone. But here is the problem of timing. Do you recycle a car battery next year? No. You recycle it in 15 or 20 years at the end of the vehicle life. The silver that goes into a Samsung battery in the year 2026 is effectively locked away and removed from the global supply pool until the year 2041. It is sequestered for a generation. The recycling wave that everyone is hoping for will not arrive in time to save us from the structural shortage of the 2020s. We are facing a massive gap in supply right now, and the only way to fill that gap is through new mining. But as we will discuss, you cannot simply print a silver mine. The industrial world is addicted to silver, but it has no plan for how to recover what it consumes. We are living on a one-way street of consumption. Every solar panel installed and every solid-state battery produced represents silver that is being taken out of the hands of investors and locked into industrial products for decades. This is why the deficit is not just a temporary fluke. It is a permanent feature of the new green economy. When the world realizes that the recycling bin is empty, the panic for physical silver will begin in earnest. If the math of the Samsung silver bomb is not enough to convince you, then you must look at the geopolitical wall. Even if we had the technology to mine more silver, we are running into a physical and political reality that is far more complex than a spreadsheet. Silver is not found everywhere. It is concentrated in specific regions that are becoming increasingly hostile to Western industrial interests. Mexico produces approximately 25% of the entire world's silver supply. For decades, Mexico was a reliable partner for global mining companies. But that has changed. The Mexican government has recently stopped issuing new permits for open pit mining. They are citing environmental concerns and national sovereignty over their mineral wealth. When the largest producer in the world decides to freeze expansion at the exact moment that Samsung and the auto industry are demanding hundreds of millions of new ounces, you have a recipe for a global supply shock. Then we look at Peru, the second largest producer. Peru is currently facing a wave of social unrest strikes and blockades that have repeatedly shut down some of the largest mines in the country. The local communities are demanding a larger share of the profits as inflation eats away at their standard of living. This makes the supply of silver from the Andes Mountains extremely fragile and unpredictable. And let us not forget Russia. Russia is a top 5 producer of silver. Due to the ongoing conflict in Ukraine and the resulting sanctions, Russian silver is effectively locked out of the official Western banking channels. While that metal still finds its way to China and India, it creates a massive hole in the supply chain for European and American auto manufacturers. This leads to a two-tier market that the world has not seen since the Cold War. I call it clean silver versus dirty silver. Under the new laws passed in the United States and the European Union, car companies must prove that their battery materials are sourced from friendly nations to qualify for tax credits and subsidies. If a manufacturer buys silver from a sanctioned nation or a mine with poor labor practices, they lose billions in government support. This creates an immense premium for silver mined in safe jurisdictions like Canada, the United States, and Australia. Samsung and Tesla will pay a massive bonus to secure silver from a mine in Idaho or Ontario because it ensures their supply chain remains legal and subsidized. But here's the problem. These safe jurisdictions produce very little silver compared to the giants like Mexico and Peru. We are heading toward a world where governments will treat silver exactly like they treat oil. It is no longer a commodity to be traded freely on a global market. It is a strategic asset to be hoarded and protected. We might see nations like Mexico or Peru decide to nationalize their silver mines to ensure their own domestic industries have what they need for the energy transition. When silver becomes a matter of national security, the free market price becomes secondary to the survival of the state. The geopolitical wall is closing in, and the silver you hold in your hand is becoming more valuable than any paper currency because it carries no political risk. To understand why silver is currently trading at such a massive discount relative to its true value, you must understand the difference between the paper game and the physics game. The paper game is played in the boardrooms of New York and London. It is a world of derivatives, of high-frequency algorithms, and of infinite supply. In the paper market at the COMEX, a bank can sell 1 billion ounces of silver in a single afternoon without owning a single gram of physical metal. This is the fractional reserve nature of the precious metals market. Right now, the ratio of paper-silver contracts to actual physical silver in the vaults has reached an absurd level of over 350 to 1. For every ounce of real silver sitting in a COMEX warehouse, there are 350 paper claims to that same ounce. When the banks want to push the price down to shake out retail investors, they simply flood the market with these paper contracts. This is what happened on Friday. The algorithms detected a technical level and dumped thousands of contracts to create the illusion of a sell-off. But while the banks are playing this paper game, Samsung is playing a physics game. In the physics game, supply is not infinite. You cannot print a silver atom. You cannot satisfy a battery production line with a digital derivative. If Samsung SDI needs 10,000 ounces of silver to coat their nano anodes, they must have the physical metal. They cannot put a paper contract into a battery and expect the car to drive 900 miles. This is the fatal flaw in the bank's strategy. They have used the paper market to keep the price of silver artificially low for decades. This low price has discouraged miners from building new mines. It has encouraged the industrial world to consume silver like it is garbage. But now the bill is coming due. The low price has created a situation where physical inventories are at 10-year lows across the world, from London to Shanghai. The Samsung Silver Bomb is the ultimate catalyst that breaks the paper game. As more auto manufacturers follow Samsung's lead and move towards solid-state technology, they will go to the market to secure long-term supply. They will not go to the COMEX to buy paper. They will go directly to the miners and the refineries. When the auto industry starts demanding physical delivery of millions of ounces, the fractional reserve system collapses. You cannot pay a car manufacturer in paper silver when they have a billion-dollar factory standing idle because they lack the metal. We are already seeing the first signs of this break in the Shanghai Gold Exchange. While the price in New York is suppressed by paper, selling the price in Shanghai often trades at a massive premium. This is because the Asian markets are more focused on physical delivery for their massive solar and electronics industries. They understand that physics always wins in the end. The recent price drop to $61.96 was a classic paper game maneuver. It was designed to make you panic and sell your silver back to the banks so they can cover their short positions before the physics of the silver-carbon anode takes over. Do not let them win the psychological war. The banks are staring at a screen. Samsung is staring at the periodic table. And the periodic table does not lie. The era of paper manipulation is colliding with the era of physical necessity. When the paper claims exceed the physical metal by 350 to 1, the only possible outcome is a short squeeze of biblical proportions. Knowledge without action is merely entertainment. Now that you understand the magnitude of the Samsung Silver Bomb, you must position yourself before the rest of the world wakes up. The markets are currently giving you a window of opportunity because the silver carbon narrative is still confined to engineering labs and deep value investors. To profit from this structural shift, you need a clear 3-lane strategy. Lane 1 is physical metal. This is your insurance policy and your foundation. But in an industrial squeeze, the rules of what to buy change completely. For years, dealers have pushed semi-numismatics collectible coins and limited edition series with high premiums. In a normal market, these might hold value. But we are not entering a normal market. We are entering an industrial vacuum. When a battery manufacturer needs silver, they do not care if it has a picture of a superhero on it. They care about the silver atom. They need raw material to melt down into nanopowder. The strategy for Lane 1 is simple. Stop paying for art and start paying for weight. Your goal is to accumulate the maximum number of grams of silver for every dollar you spend. 100-ounce silver bars and 10-ounce bars are the superior assets for this trade. They carry the lowest premiums and offer the highest liquidity when selling to industrial refiners. If you are buying right now, ignore the fancy coins. Buy the cheapest, most recognizable bullion you can find. In the Samsung era, ounces are the only metric that matters. Lane 2 is the mining stocks. This is where life-changing wealth is created through operating leverage. But there is a deadly trap here called the hedging book. Many mining companies are run by conservative managers who sell their silver production forward at fixed prices to guarantee a profit. If a company has hedged its production at $30 and the price of silver goes to $100, that company misses the entire rally. Their stock will stay flat while the world burns. The strategy for Lane 2 is to audit your miners. You must look for unhedged primary silver miners. You want companies that sell 100% of their silver at the spot price. When silver goes from $60 to $100, their profits do not just double, they explode. Companies like First Majestic Silver and Kerr Mining have historically maintained high exposure to the spot price. These are the horses you want to ride. Furthermore, look for companies with significant assets in safe jurisdictions like the United States, Canada, and Australia. As silver becomes a strategic energy metal, the political risk in Mexico and Peru will skyrocket. A silver mine in Idaho is worth 5 times more to a domestic battery supply chain than a mine in a country prone to nationalization. Lane 3 is the exit strategy. Commodity supercycles driven by technology typically last 7 to 10 years. We are currently at year 0 of the silver battery cycle. You have a long runway ahead. However, you must stay vigilant for the next technological leap. If you see headlines 5 years from now about a silver-free solid-state battery or a breakthrough in sodium-ion technology, that is your signal to begin rotating out. But for the next decade, the factories being built today are locked into the silver-carbon architecture. They cannot change their chemistry overnight. For the foreseeable future, the Samsung bid is the floor under the silver price. Ride the S-curve, accumulate weight, and prepare for the moment when the world realizes that silver is no longer just a metal for spoons and mirrors, but the very heart of the energy revolution. We have arrived at the conclusion of this deep dive. If you have been with me through all 9 parts, you now understand the full scope of the silver bomb. You understand the technology that makes silver indispensable. You understand the math of the deficit. You understand the geopolitical wall and the strategic playbook. Now we stand on the precipice of a new week. It is late December 2025. The markets are currently closed for the weekend, but the silence is deceptive. While the Western exchanges are frozen, the information is traveling across the globe. The engineers in Suwon are running final calculations for mass production. The procurement officers in Germany and Detroit are updating their spreadsheets to account for the silver carbon anode. And most importantly, the sovereign wealth funds in the Middle East and the big players in Asia are reading the same technical reports we just analyzed. The price of silver has surged nearly 150% this year. But the recent volatility is just a temporary shadow before the light of reality hits the ticker. When the market opens on Sunday evening, all eyes will be on one critical number, the Shanghai Premium. The Shanghai Gold Exchange is the physical heartbeat of the Asian market. Unlike the COMEX in New York, which is often a paper casino, the Shanghai market is focused on physical delivery. Throughout 2025, we have seen a massive disconnect. While Western banks try to suppress the price with paper contracts, the physical premium in China has been exploding. Silver in Shanghai has recently traded as high as $85 per ounce, which is $5 to $10 above the Western spot price. This is a massive arbitrage opportunity. Global traders will buy silver in New York and sell it in Shanghai to capture that risk-free profit. This arbitrage is the force that kills manipulation. To capture that profit, traders must buy the COMEX contracts and demand physical delivery. This puts a massive squeeze on the banks who are short the metal. On Sunday night, I predict we will see this arbitrage execute with extreme violence. The Asian markets see the Samsung battery factories being built. They see the 10-year lows in silver inventories. They view any price dip in the West as a final gift. I need to prepare you for the mental battle ahead. The coming months will be brutal for your emotions. The banks know they are in a corner. They know the Samsung narrative is taking hold. Their only remaining weapon is volatility. They will try to induce motion sickness. You will see days where silver is up $5 and days where it is down $5. They want you to get so stressed watching the charts that you hit the sell button just to find some peace. Do not fall for it. Remember the fundamentals. Does a $5 price drop change the electrochemical property of a solid-state battery? No. Does a scary headline on CNBC put silver back into the ground or cancel Samsung's production line? No. The fundamentals are inelastic. The silver bomb has already been detonated in the research and development labs, and the shockwave is just now reaching the financial markets. The banks are looking at a weekly chart trying to survive another day. You must look at the periodic table to secure your decade. Samsung is playing a physics game, and physics always wins. The era of the silver carbon revolution is here. The supply is gone. The demand is structural. And the time to act is now before the rest of the world realizes that silver is the new oil. This is the end of the beginning. Stay strong, stay physical, and I will see you on the other side of the squeeze.